Investors Chronicle.
Hello and welcome to Lee and the IC, the podcast where I, Alex Newman, get to spend a bit of time in the company of one of the UK's most successful private investors, Lord John Lee of Trafford. John, how have you been?
Fine, thank you. Interesting times we live in.
It is Wednesday, the 7th of May, as we record, after a 2-month hiatus, busy 2 months, as John just alluded to there. Last time, I can see from my previous notes that I described markets as being in a Trump-induced state of disarray, but as we now know, that disarray was only just getting started, really. This month we'll be exploring the associated ructions, everything that's been happening in the past few weeks in detail. We'll discuss John's reaction to last month's market drama, both at a high level, I hope, and at the portfolio level, as well as his experience of market crises in the past. And though we will talk about stocks today, none of that discussion should be interpreted as investment advice. As ever, we urge you to do your own research. John, the last time we were sitting here, we touched briefly on the tariff threat, I suppose in the context of VP, whose CEO Anna Bilby, we were interviewing. Clearly, tariffs have been the dominant topic in the 2 months since, as well as all the sorts of questions swirling around the reliability of the US-led world. What did you make of the so-called Liberation Day announcement as an investor?
Well, I think the one thing that the stock markets and investors hate is uncertainty. Frankly, uncertainty is really what has come out of the Trump administration and Trump's tariffs. It really is, impossible to be certain of almost anything he says because of the reversals a few days later, and then it can be influenced by a whole range of factors, not least the level of the stock market. A number of his big supporters and big hedge fund people clearly decided that it was time just to point out to him that they weren't over happy, should we put it like that. And so, there are people in America who can rein him in. But overall, obviously, it's been a very, very uncertain time. We've had a situation where clearly the market fell initially on the tariff announcements. But then, of course, really over the last couple of weeks, we have seen quite a steady improvement in prices. I would say broad brush, something like half the fall has been recovered. A number of the individual stocks that I managed to pick up at depressed levels, have pushed forward quite nicely. So there have been opportunities.
Those stocks, as long-time listeners know, are UK only. You invest only in UK shares.
I only invest in UK shares. And of course, there's been a feeling that the American stock market has been overvalued for some time. And increasingly, I think people are looking to the UK market. Larry Fink of BlackRock drew attention to the attractiveness of the UK. Certainly, stocks are at a level, and have been at a level particularly, where there have been some significant opportunities.
Just to return to your UK investment focus, it doesn't mean that you're focused on the UK economy. A lot of the companies we've discussed on here are globally facing businesses. Just to bring it back to the tariffs, I know it's incredibly hard to read. Uncertainty is the watchword, of course. But are you worried at all about the sudden turn the world or a US-led world might be taking? Has it changed your impression of companies for whom, for example, the US is a big market or a growth focus, and what that now means in light of all of this uncertainty?
Well, I think there have been one or two particular areas that have been hit. For example, shipping, with the question mark over trade between China and the US. Clarkson's, the biggest shipbroker by far, put out a profits warning and indicating that the shipping market was uncertain, and this has obviously had a little bit of a knock-on effect on Braemar, the holding that I have. So that is a specific. But apart from that, it's been very difficult to see any other areas that are going to be definitely hit because there is so little certainty. And the other point, of course, is that some of the companies, even some of the smaller ones that I'm invested in, like Anpario and Concurrent do have subsidiaries and having made acquisitions in the US. So companies have a considerable amount of flexibility as to how they do plan to handle the tariff situation. So I've not been over concerned. There have been indications, obviously, that one or two large cap companies have been talking about major investments in the US. But I'm not sure that the majority of UK companies have been, certainly I'm talking about the established profitable ones that are conservatively and sensibly managed. I don't think they have been too troubled.
Mm. You spoke about those, the hedge funds who are sort of sounding the alarm bells day 3, 4 into that very precipitous market slide we saw. Did you expect there to be a climb down after, as you saw markets fall, or are you taking the view that some have, that Trump is just too mercurial to even to even predict what he's going to do tomorrow?
He's certainly mercurial, but as I say, at the end of the day, he does have an eye to the stock market, and obviously there are some very, very wealthy hedge fund backers of Trump and the Republican Party who do have access to him. There's also obviously a very strong defense industrial base in the US, and they can obviously apply some pressure as well. And given the way he's chopped and changed and reversed policies, it's clear that he can be influenced. Put it that way, but it is a tricky period, and we've never seen anything quite like it before.
Yeah, just to compare it, and looking in hindsight, it feels like it was quite a brief window when markets were, or market participants were shouting panic at the start of April. But how did that sell-off compare for you as an investor to other moments of extreme stress or sudden crises that you've seen or faced in the past in your investing career?
Well, I've certainly seen a lot worse.
Yeah.
I mean, looking back, there have probably been 3 or 4 Black Fridays or left field events, as you might describe them, where the market has slumped. And by far the worst from my point of view, in terms of my experience, was in the early 1970s, when we had what was termed the secondary banking crisis, and London and County Bank collapsed, Northern Developments collapsed, big house building company Ronald Lyon Estates collapsed, rumours about the NatWest, and the stock market fell to a level where so-called blue chip stocks, good solid large cap stocks, were yielding about 20%, and no one would buy. Now that was far more extreme than the tariff fall, and then of course we had the subprime fall in the 2000s, when the market fell. Markets fall for different reasons, but on the other hand, how one reacts to them, I think, does encourage, certainly from my point of view, given the experience I've had, a degree of consistency. So you have to first of all decide whether the world has come to an end, and so if you believe it's Armageddon, then I don't know what you do. You climb a mountain and pray, or you hide under a bed with a bar of gold and a crate of whiskey. But if you don't believe that the end of the world has come, and obviously these are very uncertain times, not least on the sort of military front, with the potential of nuclear. But if you don't believe that the end of the world has come, then these events always, from my experience, provide buying opportunities, because all of them in the past have been followed by useful or significant recoveries. And therefore, on the Trump tariff situation, when the markets did fall, I certainly used the very limited liquidity I had from dividend flow, because normally I'm pretty fully invested anyway, to top up certain of my small cap stocks, which I thought were particularly attractive, and thankfully most of them have seen quite a useful bounce since I made those purchases.
Yeah, I'd really like to come on to those stocks in a moment. It's a really interesting point you make there, and I think we've touched on it here before. I suppose it's worth worth clarifying when, and I think you wrote this recently in an article, that all severe downturns have been followed by recovery. I suppose the argument you're making there is not so much how markets are going to recover, what will be the catalyst for recovery, just that if you take a kind of triumph of the optimists perspective, that markets, economies, people will pick themselves up and find a new way after a shock, that is actually is probably one of the safest predictions that you can make. And
I think that's right, and I think it's particularly true, Alex, with small cap stocks, and I tend to be focused on small cap stocks because movements are pretty lumpy, and it only takes one or two investors or one institution to decide they're going to get out of something and drop a quantity of shares on a small cap situation, that the price can fall quite significantly, and therefore I think the opportunities in some of the smaller cap stocks probably proportionally greater than in some of the large cap stocks in terms of potential recovery bounce.
Yeah, and definitely the first company I think we're going to touch on, it looked like it experienced a kind of illiquidity event last month in the teeth of the sell-off. We'll come on to that in a moment. I just wanted to touch on a few more points on the big picture, what we've seen. In recent days, we've had some reports that the UK and the US are inching closer to a trade deal. I mean, you've got some experience of trade agreements from within government and what it takes to get big international agreements over the line. Are you optimistic about what might come out of this?
Insofar as one can predict, I think I'd be mildly optimistic. It does seem that Trump does have a degree of affection, let's not exaggerate it, for the United Kingdom, given that I think his on his mother's side, she came from Scotland, and he, of course, has got investments here with his golf courses, and he seems to have quite a reasonable relationship with our Prime Minister. We've also got the visit coming up to Trump to meet the King, and then of course, despite all the bluster and the talk about possibly America, pulling away from NATO, and of course, that is a possibility. One's got to remember that there are very, very close military relationships and intelligence relationships all the time between our country and the US. And you've got individual programs like the AUKUS program, the submarine program, which involves ourselves, Australia, and the US, as it were. So are the US going to pull out of that? Very, very unlikely indeed. Also, of course, you've got a significant number of major American military bases in this country and in Europe. We've got Lakenheath and Mildenhall here, where America's invested very substantial amounts of money. Ramstein in Germany and Avino in Italy. The Americans have made very major real estate investments in these European countries, including ours. And to my knowledge, as far as we know, Trump is not inclined just to walk away from valuable real estate. So I think one's got to, be fairly calm and sensible about all this. And I don't think the situation is anything like as extreme and worrying as some people do.
Okay, calm and sensible. Nice notes to strike at always. But Liberation Day happens, or so-called Liberation Day happens. Shares slide for several days. You, I expect, along with almost every investor, would be looking at their portfolio and worrying about the level to which things had dropped. What was the maximum slide, do you recall, in your portfolio?
It's very difficult to say. I think one of the biggest fallers was Treatt, which no doubt we will come on to, but that really wasn't connected with directly with the tariff situation. And actually, Treatt has got a major plant in America, in Florida, and of course a major plant here in the UK. That was the fall, but it wasn't really a particularly a tariff fall. But on the other hand, when there is an overall negative feel in the market because of the tariffs and similar, there is an understandable tendency for everyone to adopt a fairly negative approach, and any bad news or slightly disappointing news is brings about an exaggerated fall normally.
So how do you? I mean, how were you feeling in those days? Because I mean, it's when it has an impact. I mean, maybe your investing experience has helped you deal with the emotional reaction you might feel of seeing a 15% drop or a 20% drop, or whatever it is in a stock. Are you able to sort of move past your initial gut reaction?
Obviously, no one likes to see a diminution in the value
Sure.
of their portfolio. But on the other hand, what one certainly isn't planning. Most people aren't planning on having to make sales,
Yeah.
and therefore most investors, I hope, are taking a long view, and I'm certainly a long-term investor. So to me, during a period where capital values slide, which is what we had, to me, I get satisfaction from the fact that the dividend flow has been maintained and indeed has probably increased. So I then sort of swing across and focus a little bit more on dividend flow. Not a great deal I can do about the overall capital slide, apart from use some of that dividend flow to top up some of those holdings that have fallen. And the other point is that one can never be sure when the bottom has been reached. No bell rings at the bottom, no bell rings at the top. You just have to take the view, this looks particularly cheap. It may fall further, but is it at an attractive buying level now? Is the dividend yield attractive enough to go in on? Has the price fallen, to an unrealistic level below asset value for the sake of argument, or well away from reality? And if you come to the conclusion that is the situation, then you buy. And yes, shares could fall even more. And if one's got a bit more cash, maybe you can buy at that lower level. But you mustn't try to be too clever. The key is to buy at an attractive level, taking a long-term view, and not to be too swayed by short-term sentiment and short-term events.
There's that adage, which might be a bit of we can file in the too clever by half category, to keep some spare cash on the sideline for the opportunities that sell-offs can create. Of course, for this to make a difference, it needs to be a decent slug of cash, which some investors would probably loathe to let sit idle in ordinary times. What's your stance on that?
My stance quite simply is to be pretty fully invested most of the time, and not to keep a significant block of money for really attractive opportunities, because you never know when a takeover bid is going to come along, and there are any number of shares in my portfolio which could have a bid tomorrow, and once again a sort of broad brush comment, but I would have thought over the next 10 years or so, and I hope I'm around for the next 10 years, I would have thought probably half, if not more, of the stocks that I'm in will be taken over, given the way the M&A market does work and corporate activity works. So because those takeovers can come along, you never know when, and also because I like the dividend flow, then it all points to me being pretty fully invested. And the new liquidity that I've got for further investment comes from either a takeover or the dividend reinvestment, particularly in my ISA.
So let's focus on what you did do in April, in and around April, since last we spoke. And we can start with ingredient supplier Treatt, because we've just mentioned them. I know it was one of your all-time great investments, but it had the misfortune, didn't it, I think, as we mentioned, of releasing disappointing first half results in the middle of that sell-off. So sentiment was already bad, and then it got clobbered something like 30% on the day. So on the plus side, it's highlighted its diverse global supply chain. I think, as you mentioned, the US and UK factories. But on the negative, they've got cost pressures and wavering demand. What's What's the story for Treatt at the moment, and what did you do with the stock in the last
Well, I
month?
think the story really is over the years is really an exaggerated movement both ways. I think looking back when they did touch £12, they were clearly overvalued, and people thought that great growth would continue. I think they had I remember in that final year, I think they had something like three profits upgrades, which was quite extraordinary, really. It turned out that was on the strength of a particularly good US order, which I think they hoped would be repeated, but was never in fact repeated. And so we go from that extreme to the other extreme now. There's been some pickup, but where the shares fell almost to below net asset position. And one of the great features of Treatt over the last 2 or 3 years has been the way they've handled their cash. And so despite the massive investment, 30-odd million for them in the new plant in Bury St Edmunds, they've actually now ended up in a virtually a nil borrowed situation. So they've handled the cash aspect superbly. And you've got these two very modern plants in Florida and in Bury St Edmunds. I think now the stock unquestionably has fallen too much. And that is a view that's quite widely shared. And I think that it's accepted that they are very vulnerable now, very vulnerable to a private equity opportunist bid or even a trade bid from other very large companies in the flavors and fragrances sector. So I actually bought some more. I think I paid about $250 for them, 251, I think exactly, and they then fell further. But now they've come back and they're just over the 251 mark, but still, I think very cheap. If one looks at the fundamentals of the company, and so we're never going to get back, I suspect, to the £12 levels. But I think there's a fair amount of upside, and obviously, if a takeover bid does come along, then you're going to see a real bounce.
Then there's Christie Group, which provides stock and inventory services to various sectors. I think leisure chief among them. I mean, they rarely make announcements, but their April update was worth waiting for, and I suppose defying the fairly weak sentiment that has attached to the stock for the last few years. What's the story there, and did you top up as well your holding? Or?
Yeah, well, yes, I did. The background is that they have had a difficult period, but what to me was transformational, and the market never really picked up, was the sale probably 6 or 9 months ago of the loss-making stock-taking side, which was a drain on bottom line, and they sold that very well. So not only is the loss maker gone, but also they got a very nice lump sum of cash, about £5 million, on a market capitalisation then of just over 20 million. So it was really significant, and the market hardly responded to that. I thought it was transformational. And so when, during the tariff sell-off, they were marked down before their results to about 85p, I picked up some more, and I've got a declarable holding there around in Christie's now of about 6.5% of the company. Not that I own all that personally, but funds that I influence or effectively control the management of. So it's a significant holding of mine. So I was very pleased indeed with the April announcement when the profits exceeded expectations, and they more than double the dividend. And I now think the climate is set fair for them to, over the next 2 or 3 years, to build up that bottom line quite significantly, because what a broker and a valuer like Christie's need is market activity. And what has happened, particularly to the hospitality sector, where they're very big in hotels and restaurants, is that many of those businesses are under a considerable pressure because of the increases in minimum wage and national insurance increases. So there've been a number that going out of business, and so there has been quite a significant turnover in hotels and restaurants and similar, which is obviously good news for Christie as a broker. They need activity, and they're seeing that, and they're building up their European side quite significantly as well. I mean, it's not just in hotels and restaurants that they are the market leaders as a broker, but also in dental practices, in pharmacies, in veterinary practice, and particularly in care homes as well. So they've got a very significant market position, and the business, I think, has been for many years considerably undervalued in real terms, but it's only now that the bottom line is beginning to demonstrate that. So I was very happy to pick up some shares, I think at about 85p, and the results were good. As I say, dividend doubled, and the shares now are about 120, as we talk, about 120. So it's really been quite a useful appreciation.
You've another new position in the real estate sector as well, in Workspace, I understand. So first we had, I think, I can't remember which order it was. You bought into Supermarket Income REIT and then Town Centre Securities, I think.
Yes. Well, Supermarket Income REIT is a slightly different situation because they own supermarkets and get rents from the supermarkets. So that's a very specialised business in many ways and an attractive yield. So I was very pleased to buy that on a dividend yield of about 7% and about a 20% discount to net assets. And since then, they've changed their management agreement and done a number of things which should improve their bottom line performance. But in the case of Town Centre, and also more recently in the case of Workspace, the shares have fallen to an extent where literally you're buying pound notes for 50p. That in the case of both Town Centre and Workspace, the net asset value of the business, and these are not over-borrowed businesses, is at least or around twice the present share price. And these are businesses with hard assets and very experienced management and with good dividend yields. Workspace, I think I bought on a dividend yield of about 7% and at half asset value. So I think I paid about $3.87 for the shares recently on the market fall, and they've recovered. And I think today they're about 4.45, something like that.
And I suppose a couple of years ago that might have looked like quite a contrarian purchase because there's obviously since the pandemic there's been a degree of uncertainty about the use case for prime office space, but Workspace, as some other companies have in the space have been doing, they're adopting a slightly more flexible, growth-oriented business model, aren't they?
A very specialised company. They own about 75 buildings primarily in the southeast, around London, around London, where they improve them or rebuild them, and then let the buildings out. They're really split into smaller units, and so they have a lot of SME tenants. So that is a specialised area, and they know that market very well. In the case of Town Centre, they have hard assets in Leeds and Manchester. Both those cities are pretty buoyant at the present time, and to be able to pick up their shares at half the asset value, very, very attractive indeed. So there are these opportunities, and all I would say is that from my experience over, 60 years of investing, value always comes through in the end. Now, I hope I'll be around to see some of my stocks actually deliver. But I think I'm invested in some great UK businesses, which I'm sure, given time, will deliver and indeed are delivering.
Two more we're going to cover. Vianet, formerly Brewlines. Some listeners might be more familiar with that name. So they're kind of the monitoring systems group, working a lot in the leisure and retail space. There was a big sell-off, I think, following quite a tepid January trading update. The shares have since bounced back a bit after a more positive year-end trading update. Their year-end is the 31st of March, I think. What's your history with this stock?
I've been invested in them a long time. to be charitable, it's been a slow burner, should we
Right,
say?
okay.
It's been a rather disappointing holding, but I've always believed that there was value there, and they believe their technology is quite unique and pretty valuable. And they made an interesting acquisition in the States, and there was some quite significant non-executive director buying the main individual, James Dixon, behind the business, who has gradually built it up, as it were. He has also built up his own personal shareholding, I think, to about 19%, something like that, which is a level I like to see, and that he's stewarding it pretty carefully. And yes, the results were a little disappointing. I think more on timing than on timing of renewals than anything else. They have a very significant guaranteed repeat business, as it were. I think at the end of the day, I'm sure I will see, a very nice capital profit, but quite when it'll come, I don't know. But I think the shares have fallen too much for no particular reason, and I saw it as a buying opportunity to top up an existing holding.
Finally, PZ Cussons. We've spoken about the company here a number of times in recent months. Listeners may be familiar, but John used to be on the board, so a company you have a history with. It had a very, very challenging few years, particularly with its exposure to Nigeria and currency issues. They finally decided to throw in the towel, or I don't know, maybe we can choose a slightly more optimistic analogy for the review of some of their assets in the last 6 months, and declared some parts of the business would be put up for sale. What's the latest there?
Well, we're all waiting. It's a complex situation, and I can well understand it taking a lot of time, because we're talking about. I don't think people in this country realise the size and scale of PZ Cussons' business in Nigeria, which they've really built up over 100 years of trading. They now have the leading brands in sort of soaps, detergents, cosmetics, and they have a quoted company over there that they very much have the majority holding in. They've got joint ventures also with the Chinese in white goods, refrigerators and that type of thing, and also in palm oil. And so to actually divest all that, is quite complex, and to get the right price will take time. But assuming that they do divest, and I'm pretty confident they will deliver, we're going to be left with a group with still very significant brands in this country, and also valuable businesses in Australia and in Indonesia. And if you take one step back, branded businesses, particularly consumer brands, are valuable, and they normally fetch a number times the annual revenue. That's the way, broad brush, that these brand businesses are valued at, and it can be several times annual revenue. We have a situation with PZ Cussons where the annual revenue is twice the present market capitalization, which is an extraordinary situation for a company with major brands. And so I believe it's very substantially undervalued, and I think this will become apparent, when a deal is done to divest of Africa, and certainly it's a holding that I've been building up, and I just think it's substantially overlooked by a lot of investors because of poor performance over the last 7, 8, 9 years.
Yeah. Well, if anything, I think you deserve an advisory fee for your own M&A outreach work on.
We do
on
our
the
best.
So, April, May, often big months for dividends. I know that M&G dividend, I think, is being paid this Friday. I think it is.
Absolutely.
So, what's the plan then for the next month? Is this an opportunity to recycle a bit more cash into some positions that have sold off, or are you happy to let those funds trickle in and wait?
Well, in the case of M&G, it's more than a trickle. It's
Sure.
my biggest holding, and it will be a significant dividend. I'm glad to say. And then We've got one or two smaller ones as well. So, over the next couple of weeks, I will have quite a useful amount through dividends to reinvest. And so, I will be looking to probably to build up some of my existing holdings, maybe make a new investment, but probably top up some existing ones. And looking around, I'm pretty spoilt for choice at the moment.
A final word on Warren Buffett, who last week announced he would be stepping down as the CEO of Berkshire Hathaway after 60 years at the helm. So, I mean, despite being well-known as a stock picker, I think Buffett has, it's fair to say, had the benefit of his conglomerate structure, which has been useful, I think, for him. But I was just thinking about his career and, some of the parallels, I suppose, with your investing career. John, I'm not going to flatter you by pretending you are the UK equivalent, but a couple of things that you do share, it would seem, patience, this long-term tolerance for risk, beyond the point at which a lot of investors seek to take equity-like risk, and on top of that, I suppose, deep interest and energy for investing. I mean, like Buffett, you've been doing a lot of this for well over a century. What keeps driving you?
Well, not quite a century, but
no, over half a century. Sorry,
not quite that old. To me, the stock market has been a fascinating hobby. I've had huge pleasure and interest in it over the years. It's been a wonderful challenge, and of course, so many of the events that happen worldwide and indeed in the UK, are reflected in share movements and the development and growth of particular businesses. So, there is for me this link between politics and world events and the stock market, and obviously over the years, one's tried to build up one's capital and provide for one's older age and kept possible care homes and similar. And, I like to think I've been reasonably successful over the years. Of course, if you look at Buffett's exceptional performance, initially, of course, he was investing in some great American growth businesses like American Express and Coca-Cola and similar, not the high-tech stocks. And, he saw a huge growth in those companies over the years. But then, of course, he realized that there weren't the traditional stock market opportunities for him to invest in. And then he started to buy the whole of companies, to acquire whole companies. And so Berkshire Hathaway has ended up, as a mix of owning and operating a whole range of companies, and also has big stakes in a number of the historical great US growth stories. So, it is interesting. It'll be interesting to see where his successor takes the group, whether any significant changes and what opportunities he sees. But the one thing that one does learn from investing over the years is that there are always opportunities out there. There are always new businesses being developed, new situations, and I'd be very surprised if in years to come there will be anything like the growth in Berkshire Hathaway that there has been over the last 20 or 30 years. But I'm sure there will be opportunities. It's an ever-changing investment scene.
It's a nice note to conclude on. If you have any questions you'd like to put to John, how would Warren Buffett have done? Would he have fared quite as well if he had been restricted to UK-only shares, perhaps? Or suggestions for future guests? Can send any of those to me by email at alex.newman@ft.com. Until then, all that's left for me to say is to thank you for listening, to John as ever for your thoughts, and to our producer, Maddie Apthorpe. So until next time, goodbye.